Real estate. It's where we live, work, dream, and sometimes where economies go to die. Welcome to FluxFolio Finance, where we decode the hidden engines of global money. Today, we're breaking down the real estate illusion, why property is far more than bricks and glass, how it drives nearly every economy on Earth, and why every major financial crisis seems to start when those bricks begin to crack. The foundation of growth. Across the world, real estate isn't just a sector, it's the economy's skeleton. From homes and offices to logistics hubs and shopping malls, the property market represents between 10% and 20% of GDP in most advanced economies. In the United States, real estate and related financial services account for roughly 17% of GDP, nearly one-sixth of the entire economy. In China, that number once soared above 25% when you include construction, steel, and cement. Even in smaller nations like Canada, Spain, or Australia, housing and real estate activities remain among the top 3 economic drivers. But here's the twist. Real estate's true importance isn't just in the buildings we see, it's in the credit system beneath them. The collateral channel, how property fuels credit. Every mortgage, every commercial loan, every bond portfolio rests on one assumption, that property prices will hold. Real estate serves as the collateral backbone of the modern financial system. In the US, over $12.9 trillion of household mortgage debt and roughly $3 trillion in commercial real estate loans are outstanding, together nearly half the size of US GDP. In the euro area, banks hold more than $1.4 trillion in property loans. Globally, commercial real estate debt tops $21 trillion, forming a web that connects homeowners, banks, pension funds, and governments. This is called the collateral channel. When property values rise, collateral rises, credit expands, investment surges. But when property values fall, credit shrinks, defaults climb, and economies stall. That's why every real estate boom feels like growth, until it's not. The cycle of boom and bust. History's loudest economic collapses began quietly with property dreams. In the 1930s, America's land bubble burst, triggering a mortgage crisis that deepened the Great Depression. In 2008, mortgage-backed securities turned U.S. homes into financial weapons. When prices fell, the world's banking system imploded. In China, decades of overbuilding left ghost cities and trillions in developer debt. Evergrande's collapse was not an isolated event. It was the bursting of a $60 trillion property machine that powered 1/4 of China's GDP. Even Dubai's 2009 crash showed how an economy built on construction and speculation can evaporate almost overnight. Each crisis taught the same brutal lesson. Real estate isn't just another asset, it's the amplifier of everything else. Why it matters today. When property prices rise, governments celebrate. Construction jobs boom, tax revenues climb, and consumers feel rich enough to spend. But that comfort is borrowed from the future. Because behind every skyscraper stands leverage. When central banks raise interest rates, that leverage gets heavier. When inflation bites, borrowers stretch thinner. Today, the IMF estimates that in advanced economies, 40% of total bank lending is tied to real estate. In emerging markets, it's closer to 60%. That means a global property downturn doesn't just hit homeowners, it can freeze entire banking systems. In China, developers owe over $8 trillion In the US, regional banks hold more than $3 trillion in commercial property exposure. If those values drop 20–30%, the ripple could spread through credit markets worldwide, just as they did in 2008. The illusion of wealth. Real estate makes us feel rich, but much of that wealth is paper wealth, inflated by cheap money and speculation. Between 2010 and 2022, global property prices soared more than 60%, outpacing income growth nearly everywhere. Families took on record debt, corporations borrowed against inflated office towers, governments relied on property taxes and land sales. Then came the correction. Rising interest rates crushed affordability. Office vacancies hit record highs. In the US, commercial real estate values are down 15–25% from their peaks. In China, developers default one by one, dragging entire cities into financial quicksand. The illusion is fading, and with it, the belief that property prices can only go up. Lessons from history. Every real estate crisis tells a story of ambition, leverage, and hubris. The 2008 subprime crisis revealed how financial innovation can weaponize real estate debt. The Chinese property bubble showed how entire growth models can hinge on construction. The Dubai crash warned of what happens when speculative money builds faster than demand. And the 1930s mortgage collapse proved that when collateral collapses, so does confidence. Across them all, one pattern repeats. Credit booms built on rising property prices are fragile. When the collateral shrinks, so does the economy's pulse. So what comes next? The world now stands on the edge of another property repricing. As central banks hold higher interest rates and remote work reshapes urban demand, property values face a reckoning. Yet not all is doom. Some nations are pivoting from construction booms to productivity investment, AI, green tech, logistics. Others are reforming mortgage rules and curbing speculative lending. Still, the lesson is clear. An economy addicted to real estate is an economy built on sand. True wealth isn't in the concrete, it's in the innovation, efficiency, and trust that sustain it. So, what's the takeaway? Real estate built the modern economy, but also made it dangerously fragile. It's both the engine and the anchor, the illusion and the foundation. And as history shows, from Wall Street to Shanghai, from Dubai to Madrid, when the illusion cracks, it doesn't just take buildings down, it takes the system with it. Thanks for watching FluxFolio Finance. If you learned something new today, drop a comment with your thoughts, hit like, and subscribe for more deep dives into the forces shaping our financial world. Until next time, stay sharp, stay curious, and never take the foundations for granted.